Hello, folks. Brandon Chapman with you today. It's another edition of the Monday video for TheoTRADE. It is April 8th, 2024. Boy, an interesting day in the market as we're basically flat on the session. I say interesting only because we've had more volatile days, and all of a sudden today we put in a range in the ES futures of about $32, which is not very significant. If we go to edit studies here, we can bring up an ATR study. And we'll see that the ATR, the average true range, the difference between the high and low or the previous day's close to the next day's high and low is about $52. So we're very underwhelming in terms of today's range and the volatility markets. Well, they're pulling back at the moment. Currently, the VIX is standing at about 15.3. So is this the pause or the calm before the storm? Is the, shall we say, the sun about to be blocked? We're talking about the potential of this bullish trend that we've seen in the market. We're going to be starved from light and warmth during this solar eclipse. So again, this today may mark a kind of a pivot or really a continuation of the selling from last week. And this begs the question: the hot area of the market over the last few weeks has been to be long gold. It's been to be long silver. And certainly if you've been long energy shares, you've done fairly well over the last couple of months here. Is it now time to consider taking profits? That's what we're going to talk about today. It is a data heavy week this week. We've got a lot of inflation coming up, inflation data coming up, core CPI. We've got PPI on here as well. We've got the Fed minutes on Wednesday too. So a lot of stuff that could create some movement, and not just movement in interest rates. We look at the TNX. It looked like we were going to kind of break out today a little bit. Yields are kind of towards the high of the session, maybe even the highest close we've had in months. Are we starting to see a pivot on interest rates or a breakout in interest rates that may create problems? When you look at the TNX here since the low back in December, then the low in February 1st, if we correlate this to gold prices initially kind of sold off here, but then bottomed around the 14th of February, and it's been off to the races ever since. It's unusual. It's unusual to see treasury yields generally rising and gold performing that well. Normally, you'd see, because of the kind of the competition in terms of yield on gold, normally you see gold pressured as yields are rising. But we've had a scenario where, yes, demand for our bonds haven't been as strong. Yields have been rising, and this has caused weakness in the dollar. So when we look at gold prices surging, when we look at silver prices surging, when we look at agricultural prices surging since early February, and also oil prices, this comes down to what? A weak dollar helping to propel many of these commodities higher. Even, look at /HG off of the February lows down here. Copper prices have gone up dramatically. So it begs the question: when do you take profits in gold if you're long gold or gold stocks? When do you take profits in silver if you're long silver or silver related stocks or commodity companies like, for example, a Freeport-McMoRan? When do you decide to take profits? Now, I can tell you how I've been kind of taking the trades I've been talking about during my sessions at TheoTRADE. We've been looking at being long silver since the breakout back here on February 15th. But even this most recent run, we talked about initially being long a spread 23-25. And then once we got into this area here, we rolled 25 to 27. Stocks like AG that have seen significant option activity, initially a 6-7 and then a 7-8, rolling into the strength. And these spreads have yielded around a 230% potential profit, or around 130, 160%, I think it's 130% profit in SLV. But when do you take profits? Again, circling back to this week's calendar, CPI, PPI, and there's the bell, FOMC meeting minutes. What do these things have in terms of power of moving the dollar, which has really been the driver for higher gold prices? Remember that gold and silver, GLD in particular, is almost exclusively influenced by the dollar. So if GLD is going up, guess what? The dollar is going down. And I don't want you to mention, say, oh, well, look at the euro slash US dollar, EUR slash USD. Well, EUR slash USD. I don't want you to tell me that, well, the dollar really hasn't sold off against the euro. The euro's not taking off up here, right? Or look at the US dollar slash JPY and say, well, the dollar's not smashing the yen right now. I get it. But here's the problem though. You're looking at other currencies that are also freely floating, right? In terms of their exchange rate. So the problem is there is nothing backing the yen. There is nothing backing the dollar. There is nothing backing the euro. They can all be declining simultaneously. And it's just a race to the bottom. And so when we look at gold, what we're really looking at is gold, GLD specifically here, in dollar terms. So if GLD is going higher, all things being equal, if GLD is going higher, the dollar is going lower, all things being equal. Gold has very little economic value. I mean, what do we use it for? Right? It's not a great commodity. It's soft. It's heavy. Yeah, I guess you can smash it out and atom thick and coat stuff, but not very much of gold, physical gold, is used for production. And so as a result, it's historically been a great source of, or a form of money as a medium of exchange and store of value. So as a function, as the dollar diminishes, since GLD is a relative strength line with the dollar, if the dollar goes down, guess what? GLD is going to go up, and that's what we've seen. As we've seen deficit spending explode in the United States and other factors, we're seeing what? The gold explode as the dollar implodes. And again, don't look at other currencies because everyone is a race to the bottom of devaluing their currency. And yes, the dollar might be making gains against some stocks and losing ground against other currencies. The fact of the matter is gold's going up because the dollar right now, nobody wants it. And yields are going up as well. There's a little bit lesser demand for our bonds, and as a result, yields are moving higher, in part because there is some expectation the Fed may be more on hold than was thought at the beginning of the year or even in February. So as we look at things right now with inflation data on the docket, we have to understand is there is risk for the dollar to rebound. And what would that look like? If all of a sudden inflation comes in much hotter than expected, and all of a sudden we start to erase a lot of those rate cuts for this year, there is a chance that the TNX really starts to break out here and goes towards 5% if those rate cuts are starting to come off the table. The Fed funds rate's 5.25% to 5.5%. Yes, if we're in more of a rate cutting, more of a disinflationary bent, prices may go up and yields may go down on the 10-year. But what we've seen recently is that all of a sudden some of the rate cut odds are starting to diminish. But this week, in terms of inflation data, this is our first look for March inflation before PCE comes out later in the month. We may see that things are hotter than expected. And if that's the case, we may see real selling in gold and other commodities like oil, etc., because the dollar is strengthening. Now, look here, we're expecting it to decrease from the previous for core and headline CPI inflation. We're expecting to increase year over year. What if this comes out and surprises to the upside? And pipeline inflation in terms of PPI, right? The headline's 0.3 versus 0.6. Last month was hotter than expected. Again, 0.2 versus 0.3. We're expecting inflation numbers to cool off from last month's hotter print. What if these come in hotter than expected? Again, expect that the dollar may strengthen. So this may be exactly the point. If you're looking at gold, you're looking at silver, you're looking at oil, specifically in oil shares like XLE or the periphery in oil, this may exactly be the opportunity to look to take profits ahead of these announcements. Because boy, things could really sell off hard if we see that the inflation rate come in hotter than expected, and all of a sudden the Fed has to back away from it. Now there is ways to roll and other ways with options to kind of keep your skin in the game while removing some risk. But taking profits doesn't necessarily mean taking your entire position off. It may just mean taking half of your position off. But this is a point where it's good to hold on to what you have. Bitcoin breaking out today. And yet we saw very little really strong action in the options market and stuff like Mara, for example. Mara finished down today. So we're not seeing that trade going back into cryptocurrency stocks. BITO obviously is the crypto futures ETF, but even stuff like HUT, for example, Riot, you can go down the periphery of these companies and you're seeing, man, there was not a lot of strength today based on the breakout. So again, if the dollar strengthens, Bitcoin may be vulnerable despite its breakout today from a symmetrical triangle that it's been developing over the last number of weeks here. So again, we did not see crypto stocks move with today's breakout in Bitcoin, okay, as we're approaching the halving event here in the next couple of weeks in Bitcoin. So again, right now, we're in a vulnerable position for the market to decline. Now, you can say, well, yeah, fundamentally for oil prices being in backwardation. So if we look at forward/CL, what you'll see is that prices are declining in the future. This is positive. This shows there's a shortage for oil. And I get it, right? The fundamentals for oil are relatively strong. Even at this price at around 86, we might see 95 before it's over. But the threat right now is that we go down before we start to go up again. And this is the point where if you're talking about option trades where you're relatively shorter term in nature, when do you take profits? These are certainly the point where taking profits makes sense. If we look at GLD and we bring up the auto expected move here, just to give a sense of perspective, the auto expected move on gold, you'll notice that we broke out of the auto expected move or the expected move range, really 1, 2, 3, and we may get there this week pending some strength in the dollar. But we've had 3 consecutive weeks trading above the expected move. And we go back before that, we had 1, 2, 3 consecutive weeks there. So 6 of the last 7 weeks has found a close above the expected move in GLD. If we look at SLV, for example, again, a commodity, but again, we're breaking out above the expected move. We traded below, but right here, we trade above the expected move between the last week, significantly above it. So we've had some very extended moves. And I'll tell you, last week in silver, you take this range here from 22.79 to about 23.32. We were trading likely 3 to 4 times above the expected move last week. And we're up nicely today in SLV about 1.5%. It makes sense. At this stage, we might begin to cool off or sell off. And again, looking back to whether you take profits or not. And to kind of point this out in terms of the option market, today, AG. AG's been on a phenomenal run. This is a stock that we've been following, as far from a trading perspective since the 28th here. Again, taking that 6 to 7, then rolling to 7 to 8. I discussed my session today, possibly taking profits, 230% gain, depending on where you filled here. But the idea of AG, well, if we look at the options market, we're seeing some trade come in the opposite direction. This is for a 12 April expiration on AG at the the $8 strike price here. I got it right here. I was trying on the put side. I'm like, wait, that doesn't look right. Looking over here at the 750 put, 6,200 call, 6,200 contracts, mostly bought. And you look down here, 51% at the ask, 28% at the bid. We're seeing some put option buyers step in here as AG is kind of peaking. We had kind of a neutral candle today in AG, reasonable to close at this stage. Again, it was 7-8. We talked about just closing out the spread versus rolling it again out to 8 to 9. You could do that, or just take some of your contracts off the table or close it all together. But again, I think that's an interesting trade today in a stock that's really propelled itself over the last little bit of a week as silver prices are surging. Another one today is Cenovus Energy, CVE. CVE has been a huge tear of late. 1, 2, 3, 4 consecutive weeks above the expected move. Last week, we're probably almost 3 times above the expected move. We're basically flattish today on CVE. And the trade, this is a May expiration. Out here, we're seeing puts being bought at the $20 strike price. again, this doesn't mean the price is going to go down, but you're starting to see some bearish interest come into Cenovus Energy, which has been one of the leaders in the energy space over the last 4 weeks. And so what do you do with this kind of signal? Take profits, right? Take some off the table, roll them potentially. Other stocks we've looked at over the last week are stocks like RIG and MRO and other energy stocks. This is a reasonable time to consider to take some profits off the table. Again, you could roll or close half or all. And again, we're getting some early signs. And again, leading into some inflation data, a stronger dollar could really put a kibosh on the rally we've seen in these shares over the last several weeks. And so again, there's kind of a couple of unusual option activity trades centered around this. Also, we think about banking. I mean, financial stocks have really led out here over the last while. They've performed strongly. We have a scenario where JP Morgan's consolidating. It was higher today as well. Do you start to take a stab at if yields start to break out to the upside? We start to see their holdings, which have exposure to treasuries, and that those unreal losses expanding as prices go down and yields go up. Today, JP Morgan, we're seeing a May expiration. Look into the downside here, 190, 170, long put vertical, right? Notice the skew, benefiting by 24%, selling 31%. This is a reasonable time frame and strikes. If you're thinking about trading, so you could even keep it tighter, 190, 185 if you want. You could come here to weeklies and get in, still $5 strike prices. We're talking about $5 strikes, but again, you could keep it tighter and you're still benefiting from the skew. But the point is, if we see hotter inflation, we see that the Fed is not going to cut rates this year. All of a sudden, JP Morgan's profit forecast that led to this little boost back here, they've got earnings coming up on the 12th. We may see that there is trouble brewing for financials if the Fed is not going to cut rates and inflation is hotter than expected. So today, maybe you don't want to carry it through the earnings like that. You can go to XLF if you want. But on JP Morgan, that was the trade here. So if you're correlating it to XLF, just look at that kind of same expiration out here in May. And what you might do is just take a 41.39, right? We're at 41.75 right now. How about a 42.40? Costs you about 59 cents on a $2 wide spread. Break even is 59 cents below 42. Those are reasonable options as a means of trading a bearish earnings that's coming up here on the banking space this week on the 12th for JP Morgan. Another banking stock, let's take a look at VLY. This is one of those regional banking stocks that have really been hammered by the treasury market selling off. So far, the company's been kind of hanging in here, right, in this range. This one that kind of really led the sell-off back here with others, with the New York Bank. I forget what the name of it is now, but Valley's what we're focused on now. What you're seeing is declining highs and equal lows at around the 735 level. If we break, we could see significantly more selling. There's earnings coming up on the 25th today, and the trade on VLY was for in April at the $8 strike price right here. It's at the money, slightly in the money here. Again, there's lots of options. In fact, you could translate this to a regional bank ETF, an industry ETF versus trading an individual stock within this industry. And again, look at the volatility skew. It's beneficial for buying it out of the money, put vertical, currently about 49, a 49.47 at this point, deep and wide, 1 month, 2 strike vertical is a way to play an ETF versus trading an individual stock. Costs about 79 cents on a $2 wide spread. Look to close that out for maybe about $1.30 if we see a sell-off here in KRE. And again, is Valley kind of a indication of potential selling? Well, it was back here as we saw unusual option activity in Valley back here. So again, these are stocks that can kind of lead the expected move in many of these companies. And right now we're looking at bearish pressure on financials based on today's activity and some bearish pressure on silver and gold stocks. And this dovetails nicely with hotter than expected inflation and rising 10-year treasury yields, all would kind of create that bearish pressure on those names. And I'm not suggesting going bearish on gold and silver, going bearish, considering going bearish on banks, but considering taking profits or some profits on energy, gold, and silver. Anyway, folks, we'll wrap it up there. We'll see you back next week on the video.